Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Lizzy Bird, and we're an hour away from the opening trade. Here's what you need to know. President-elect Donald Trump's economic team is considering a plan to gradually increase tariffs using emergency powers, all to limit the inflationary impact on the states. And Chinese officials are evaluating the possibility of Elon Musk acquiring TikTok's U.S. operations if the company fails to fend off a controversial ban on the short video app. Plus, French Prime Minister François Bayrou will deliver a crucial policy speech to lawmakers today to avoid a no-confidence vote and balance the budget. Lizzy.
We're checking in on these markets, Kriti, and the uncertainty over how Trump's economic policies are going to be implemented continues to weigh on these markets. Our scoop that his tariffs are going to be implemented gradually, boosting Asian stocks and Wall Street futures. Don't read too much into this Nikkei 225 move. That is a reaction delayed to the Friday jobs report. Obviously, Japan on a holiday yesterday, but FTSE 100 futures flat to the downside. Not much move on the yen off the BOJ's remarks about hike expected next week, and Brent still hovering over $80 a barrel. The countdown to the opening trade starts right now.
Good morning. Tuesday morning. You want to know how the market feels about the world right now? Take a look at the reaction to this Trump story that we've broken overnight. The fact that maybe it is possible that we could see some of these tariffs being implemented gradually. It is in some ways not new. There's all kinds of things clearly being thrown around, and trial balloons are clearly being floated. Ideas are being put out there. But the market reaction just tells you everything you need to know about how worried the market is right now, Kriti.
Well, it's a fascinating one as well, because, look, we should really cushion this. This is not official policy yet. This isn't even close to official policy. Nope. This is an idea of a potential idea that they could eventually present to Donald Trump, who may or may not agree with it down the line. But it's crucial because this is addressing some of the domestic concerns that both Janet Yellen and Scott Bessent have talked about, in that there is an inflationary read-through from tariffs. And what this move does is basically kind of bypass a lot of the congressional debate around it, making these gradual hikes, putting it in the hands of Donald Trump, but then limiting not only the domestic impact, but then the counter of that is also perhaps limiting the international surprise impact.
Yeah, so kind of getting the best of both worlds if this goes ahead, in that you get it as a negotiating ploy, having the tariffs, but not adding to inflation as much as all in one go. But look, this uncertainty, as I say, weighing on these markets this morning, the weakening of the dollar, slightly boosting the pound perhaps,
yep.
And that feeding into the FTSE story this morning.
Tells you that Trump seems worried about inflation as well, though, doesn't it?
Yeah.
Clearly this is a factor. If Hassett and people like this are talking about the idea that we may need to do this to avoid the inflationary impact that tariffs could bring, clearly they are nervous about the impact that it could have. You already see in the UMich data, and you've got other data pointing in this direction as well, that consumers are worried about inflation and increasingly worried about inflation. The Trump team needs to figure out how to satisfy the boss and deliver tariffs, but not undermine him by delivering inflation.
And you're seeing it, you mentioned the data as well, you're seeing this in inflation expectations. Look at the break-evens, 1, 2, even 5 years out. Already this is something that's getting priced into the market and priced into the rates that then affect the equity market as well. We should also mention very quickly that this is something that is a major political issue in the States. People voted on economic policy. They voted on the inflation story. It was one of the factors that led to a Democratic loss as well. This is something that he has to do to not just appease his base, but perhaps pave the way for Republicans in the future.
Yeah, we should talk about another big Bloomberg scoop this morning, though, and this is Chinese officials potentially looking at selling the US operations of TikTok to Elon Musk if they can't avoid a ban in the US. So we're still waiting for that formal decision from the Supreme Court. It looks like they're not going to be TikTok's saviour here. And bearing in mind, we have a fantastic chart of this, that TikTok's valuation is like a tenth of Elon Musk's total wealth. This is imminently possible here. But, you know, if X takes control of US TikTok, that could also help.
Think anybody's told Elon Musk about this?
Well, we haven't had a comment from him on it. But, you know, coming back to the tariff story, it's a way that Trump could do what he says he does best, negotiate a deal.
It's an interesting one as well, because TikTok, one of the potential suitors for this was big tech at the end of the day. This is something that has an actual market read-through, the likes of Meta, Apple, Amazon, Microsoft, in terms of not just a potential acquisition that the Chinese may have to fight with, but then also in terms of the market reaction. I want to bring up another very quick deal that I think is going to tie into this national security story. Sorry?
No, yeah, we should come back to TikTok in just a second.
You do TikTok first.
OK, let's carry on with the TikTok conversation just for a moment. The most interesting thing that strikes me is the fact that, do you know what the biggest downloads on the Apple platform are at the moment?
TikTok.
No, not TikTok. There's two other Chinese lookalikes.
Oh.
One translates the Little Red Book. Basically, the biggest downloads happening in the States right now are basically for Chinese replicas of TikTok. So the benefit that could accrue to Reels, etc., may not come, because all the people that are coming off TikTok are going onto other Chinese applications. Oh. So you do wonder whether or not actually the value could be diminished quite quickly. Yeah, that's a very good point. A market read through there as well. But then from a national security perspective was the thought that I had, was simply that this is coming at the same time. So there's another deal that we've got our eye on in terms of U.S. Steel that was getting a rejection from or blocked bid from Nippon Steel. And now there are U.S. players that are actively upping the commodity space. I bring these two stories together because it highlights this national security push out of the United States that's actively affecting the tech space, the oil space, the steel space, you name it. Trump policy is showing up. It's Biden policy as well. We're looking with the steel story. You're looking for a U.S. equivalent that will replace the Chinese, Japanese equivalent that is operating in your country. But it's interesting. Maybe the TikTok story reflects the idea that actually that is going to be harder to do, and with less effective outcomes than maybe originally anticipated.
But you've got, like, the national security concerns. You've got the concerns about children addicted to social media. Just because TikTok's US-owned doesn't necessarily mean that it's better for kids.
Absolutely not. The two are separate issues, and this is being presented as a national security issue. This is about the algorithm and data rather than child safety. Let's talk a little bit about France and what is going to be happening. Beirut is going to be on his feet a little bit later on. I think it's just after 2 o'clock. Yeah. He is going to be delivering a general policy speech. The negotiations, I'm not even sure they've concluded yet. They probably went late into the night last night in terms of what he can actually say. The hope is that he can bring the socialists on board with some sort of a deal around pension reform. Yeah. Liberation were talking yesterday about the idea that the socialists basically want him to say that he is going to suspend the 2023 pension reform that Macron so unpopularly pushed through. If those words do not cross his lips, then maybe the censure is still on, and this is a government that is going to fall fairly quickly. So today feels like another really big day for France. And what those metrics actually look like, because the new finance minister, Eric Lombard, is also talking about a deficit that targets 5% to 5%, 5.5%. We had this conversation in November with Michel Barnier, and the goal then was 5%, and it's slowly ticking higher and higher and higher in terms of that deficit widening. So the argument here that France is going to try to really put on spending cuts and really address that deficit is actually waning in terms of just how much progress they can make on that front.
And of course, the French political uncertainty continuing to weigh on businesses, and we've heard it from Bank of France that they're continuing to suffer here, that in their monthly survey. So it's really interesting. I went to look at Les Echos' front page this morning, and they don't lead with this story. What they lead with is the fact that the UK and France, in the same headline, are both being buffeted by global bond markets and the bond vigilantes. That's seen as being, maybe in terms of those that lay out that page, as a more important story right now than maybe what is happening in the French National Assembly a little bit later on, which I think is fascinating as well. The power that the bond market globally is having right now here in Europe really being represented there. Let's talk about what we've got coming up on the show. Famke Krumbmuller is going to be joining us, EY Executive Director for Geostrategic Business. We'll talk about what is happening in France. We'll talk about the impact. Sebastian Raedler, Bank of America Global Research European Equities Head, is going to be joining us as well. Get his call on what the rest of this year is going to be looking like. It's barely begun, but wow, it has been bouncy already. And Rupert Harrison, who was Chief of Staff to UK Chancellor George Osborne and Chair of the UK's Council of Economic Advisers from 2010 to 2015, is going to be joining us. Reeves is going to be on her feet a little bit later on, we understand. Yeah, and it's her first big speech after her trip in China. That's ostensibly what this is going to be about, but of course she's going to have to take questions on the UK market turmoil. So we'll await that, but we've got plenty else on the docket as well today. 11 a.m. London time, we'll get a read on on small business optimism over in the US. 1:30 p.m. London time, of course, it's US PPI, and the market likely to react, given that this feeds into the PCE data set, of course, the Fed's preferred inflation gauge. Then, as you say, Guy, we have Reeves speaking in Parliament, and then at 8:05 p.m. London time, the Fed's Williams speaking. But also, as we've been discussing, we have the French Prime Minister François Bayrou outlining his policy agenda in the French Parliament as well. So plenty for economics and politics to watch out for today.
So in theory, the CPI data tomorrow is a much more important number, and I think probably that is where you'll get the bigger reaction. The interesting thing will be today is how the market reacts to PPI. If the PPI comes through hot, will the market take that as a green light, basically to signal that the recent pricing of the Fed is the right way to go, that we can take those Fed cuts off the table? PPI normally doesn't attract this kind of attention, but I wonder whether today it will.
It's certainly a good one. Let's be real. The markets are going to, if they don't get what they want to hear, they're going to say, well, let's wait for CPI tomorrow. They're going to be on the edge of their seats on that front. But I think the PPI data set, to your point, is a big one to watch for two reasons. One, because yesterday we talked about these massive exports coming out of China, that $1 trillion in terms of front-running the Trump tariffs. That's going to show up in the PPI data, maybe not today, but in the months to come as well. And then any impact on LA ports, for example, off of the fires, and in terms of import story, that's going to show up in the PPI data as well. So this is a data set that, of course, is important today, but is also going to be extra important in the next coming few months.
What else do we need to know this Tuesday morning? Let's talk about the details. The US President-elect Donald Trump said he believes negotiators could conclude a Gaza ceasefire deal before his inauguration next Monday. Israeli officials say the first phase of the deal could see Hamas release 33 hostages, including the remains of those who have died in captivity. Outgoing US National Security Advisor Jake Sullivan told Bloomberg that he is also optimistic.
I think the pressure is building for Hamas to come to yes. I think Israel also has achieved a huge amount of its military objectives in Gaza, and therefore they are in a position to be able to say yes. So there is a distinct possibility that we can get this deal done this week.
Jake Sullivan. Spain is proposing that non-EU residents pay a tax of as much as 100% when they buy a home in the country, a move that could particularly affect buyers from the UK and Latin America. Prime Minister Pedro Sanchez says non-EU residents bought some 27,000 houses and flats in Spain in 2023, contributing to a housing affordability problem. The government's proposals are inspired by tax regimes in Denmark and Canada. Talking of housing, Southern California faces another round of dangerous fire weather, even as crews struggle to contain wind-driven blazes that have paralyzed Los Angeles for nearly a week and killed at least 24 people. The disaster is expected to be amongst the costliest in U.S. history, with estimated damages and losses between $250 and $275 billion. The winds are picking up. It's a situation that is not getting better. In fact, it appears in some ways to be getting worse. The total loss number is enormous. The insured number is significantly smaller, and that gap feels like it's getting bigger and bigger, and that potentially could be a problem somewhere down the road.
Yeah, does this change policy? Does this change the way that companies operate in that area? We're already seeing, and this is on top of the fact that the likes of Allstate and Travelers, et cetera, have already pulled out some of their policy insurance in the last 12 months or so, and that became a major political issue in the states as well. This has an economic impact. We continue to talk about this. California is a major kind of the biggest GDP contributor to the states. This is going to show up in the data.
Yeah, interesting to see the California governor seeking this $2.5 billion deal, a Marshall Plan for LA, but worrying publicly that the Trump administration isn't going to give them the aid that they need to reconstruct.
Is this going to show up in the regional bank numbers that we're going to see over the next few days? The bank reporting season's about to start. I suspect there's going to be some evidence of this showing up, maybe particularly with the regional banks. They've obviously got the commercial real estate issue to fold in there as well. Yeah. But I wonder whether we start seeing it showing up in the numbers. I wonder, as we get into the big banks also reporting numbers this week, whether they will talk about this. There are links into various different parts of the economy. I talked yesterday about what happens with mortgages. That's certainly going to be something, but also commercial real estate will be affected by this. How does that affect what is happening with the regional banks too? How much of this is insured? How much of it's not insured? How much of it's rebuildable? at a reasonable cost? I think there are a lot of questions, but at the moment we're still in the firefighting phase, quite literally.
And the operations piece of that is crucial. You mentioned the banks, but all sectors, really, a lot of their kind of businesses and their China relationship happens out of California. So how does this affect, just kind of on an operational standpoint, how they approach the Pacific and beyond? Coming up on the program, GSK CEO Emma Walmsley says she's open to working with the incoming U.S. administration despite vaccine skepticism and tariff threats. We're going to bring you some of that interview with the boss of the British drug maker later in the show. Plus, the European Union's top digital official has said the repeated cutting of undersea cables in the Baltic Sea cannot be fully accidental. That exclusive interview in the program as well. But up next, we're going to go and dive more into the markets. We're joined by Philip Saunders, director of the 91 Investment Institute. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
I think tariffs on China and probably on auto imports from Europe are probably coming. That is part of our baseline, and that is going to have an impact on inflation and on growth. Not a huge impact.
That was, of course, Goldman Sachs chief economist Jan Hatzius talking about the tariff story, talking about the inflation story. Let's dive deeper into the U.S. market's reaction to our scoop on Trump tariffs, the fact that they may be gradually implemented to deal with maybe the inflation risks surrounding it. Valerie's got all the details.
Guy, it seems like from the market reaction from this scoop, the standout performer has been what's going on in Asia. These Chinese equities really taking a jump higher. The CSI 300, that's the mainland Chinese shares, jumping over 2.5%. The shares in Hong Kong and the Hang Seng up nearly 2%. It seems like this gradual approach to tariffs, if you look through the lens of what they've proposed on China specifically, that could be a bit dovish when it comes to tariff on China. We were promised a multiple of 20. Gradual tariffs of 2 to 5% per month doesn't seem to add up to that very quickly. If we look onto U.S. assets, though, they do seem to be welcoming this term of gradual tariffs. We're seeing the equity market in the green and the Bloomberg Dollar Index trading slightly softer. But, Guy, what else this could show is that perhaps there isn't a concrete plan for tariffs. We have Inauguration Day next Monday, and we were maybe, I guess, guarded against the possibility of a hard and fast tariff announcement. Perhaps these tariff leaks that we've had in the last few weeks show that there isn't really a big plan on the table, and that's dovish in itself. I want to laser focus in on the Bloomberg Dollar Index, because if we look at CFTC positioning when it comes to leverage accounts, those hedge funds accounts, we are still overly stretched when it comes to those dollar long. Any further tariff disappointment could lead to an outside move in the dollar down to the downside.
It's amazing. Just little kind of balloons being floated, ideas being maybe suggested. Look at the market reaction. Valerie, thank you very much indeed. Joining us now, Philip Saunders, director of the 91 Investment Institute, joining us around the table. Good morning.
Good morning.
We have a mini bond crisis on our hands right now. We don't know which direction it's going to take us. We've seen yields rising rapidly and surprisingly, given the fact that the Fed has been cutting rates. Do you think we're getting to the conclusion of that sort of this phase of what is happening here? If so, what do you think the right investment decision is now?
Yeah, it's interesting. I think we are definitely approaching a culmination of this particular move, because it's been going on actually since the autumn of last year. So this is not a new thing. But what is new is that it doesn't really obey historical precedent, in the sense that normally when the Fed is cutting, then actually it's a good time to own bonds.
Yep.
So we're seeing the yield curve normalise. And generally speaking, we've got so used to that sort of post-GFC period of repressed interest rates, long-term interest rates, and we're undergoing this normalisation process. So I think what's been happening recently is all about that. The yield curve, growth in the US is pretty good. 3% in the final quarter, so it has momentum. And so therefore the Fed isn't going to be able to cut much from where we are. The market is actually taking that on board. And we need a term premium. That's normal. So I think we're closer to the end of this particular. It's a squall, not a storm.
Do bond yields need to come down for equities to go up?
No, I don't believe they do. I mean, obviously, it's helpful if they do. But the cost of capital has been repriced. We're going to have to live with that. Equities are going to have to live with that. But, go back before the global financial crisis and, this kind of interest rate structure didn't impede growth then. So why should it now?
To what extent, though, is this sell-off that we're seeing, even this term premium that we're seeing, really front-running a lot of policy that we don't know and therefore creating a market dislocation? I mean,
clearly there's a lot of uncertainty at the moment. The previous reporter was talking about tariffs, and which I think is one of the sort of key uncertainties. Yeah. Does Team Trump really want a trade war with China at this moment? I mean,
it kind of sounds like it.
Well, as one reporter said during Trump 1, you got to take him seriously, but not literally. And I think that is great advice. Yeah. And we've got to see how this unfolds. But, we've got an administration that's staffed with, businessmen. These people are pragmatists. Trump is a pragmatist. Yeah. And so, therefore, some of the sort of scarier outcomes, the tails, I think are being sort of exaggerated.
So Guy made the point that you're seeing Fed cuts that have been kind of sort of digested by the markets, and yet yields are actually skyrocketing. So you're seeing policy and actual market reaction diverging. To what extent is that market reaction then almost front-running any impact that the Federal Reserve has, given the record amount of money that's still on the front end of the curve? So if you price in inflation expectations that are higher than what the Fed is pricing in, is that the policy rate that's affecting the economy?
So I think this is more about growth than inflation per se. We're actually pretty constructive sort of about the course of inflation this year. People tend to underestimate the lags involved. It took a long time to, you remember all that period whereby sort of inflation was going to proving far stickier than people expected. I think that it's probably going to go lower than people expect over the course of the next 12 months or so. Now, I entirely buy the fact that we're in a new interest rate and inflation regime, and on balance, inflation is going to be higher looking forwards, and we're in a very different market regime to the one that sort of the disinflationary regime that was initiated by Volcker in the early 80s. These bond bear markets, or bear markets generally, are processes of discovery. They take a long time to get properly priced. And I see this, episode very much along those lines.
Just going back to tariffs, Philip, flicking through your notes, you say China's turned a corner. I wonder how you can be so confident when there's so much uncertainty around how tariffs are going to impact China.
Sure, but then again, I've got an investor mentality, and I like uncertainty because that creates opportunities. And I think the narrative at the moment is extremely negative about China. Everybody, certainly Western commentators, are very negative about China. You hear this sort of endless thing about the sort of property crisis unresolved, deflation, where bond yields are, and so forth. But, there is a building response to that. And whilst I think that sort of, the sort of Xi policy approach on a medium to longer term basis is not going to be particularly productive, on a more cyclical basis, I think we're seeing the wheels turning that will likely lead to growth outcomes this year being better than the consensus expects. Look at commodity prices, actually pretty firm at the moment.
Philip Saunders, director of the 91 Investment Institute. We will leave the conversation there right as you got to the juicy stuff, the commodity prices. But Guy, I think this is a key point that he's making here, which is the shocks that you've seen, these inflation shocks. You might actually see inflation come down on the back of it more than expected. Is that a reaction to the fact that supply chains, companies, et cetera, can recalibrate faster than maybe they could 5 years ago?
Two things to say. One, gas prices are going up. They're up 50% circa year on year. Maybe that's going to feed into the inflation outlook the ECB and the Bank of England are going to have to deal with. The second thing is the rest of the world cheap enough now to be the kind of the hedge against what is happening in the United States? Are we there yet in terms, or have we been there for a while, in terms of just how cheap some of this stuff is? China, Europe, there's plenty of options. What
BOE officials will tell you is it depends what the level of the tariffs are, whether you get this diversion.
Yeah, it's certainly going to be an interesting one. And the underperformance in Europe, is it, again, to the guy's point, cheap enough to buy? At least that's one of the bull cases for French assets, whether you're looking at the bond market, the stock market, arguably even the euro as well. Coming up, we're going to talk about the policy behind it. The French Prime Minister set to present his policy agenda to Parliament. We're going to look at whether Francois Bayrou can succeed where his predecessors have failed. We'll dive into the details next. This is Bloomberg. 30 minutes away from the start of the opening trade. Futures looking very, very positive. Emphasis on very. I mean, you're looking at your Stoxx 50 futures higher by 0.8%. The CAC 40 almost higher by 1% in just futures trading. We'll see if it actually holds at the open. S&P futures are only higher by about 0.3%. I should mention the FTSE 100 is basically flat on the day, so some pretty decent underperformance coming from the UK. If you look at the bond market picture, a similar story. You are seeing just a retracement, it feels like, of the move we've seen in the past couple of days. The Treasury market is down about 2 basis points, and it looks like you're seeing French, German, and Italian yields follow that trend. Not massive moves, but Italian yield down about 1 basis point. I think a lot of this may be contingent on some of the policy agenda we get out of France later today. The French Prime Minister due to present his policy agenda to Parliament this afternoon. Francois Bayrou faces tense discussions on this year's budget, with France relying on special laws to keep the government functioning. Let's go live to Paris now and get the latest from Bloomberg's Caroline Conan. Caroline, walk us through what we can expect from that policy speech today.
Immigration, pension reform, and of course budget. These are the three hot topics that the new Prime Minister François Bayrou will talk about in this general policy speech. He has promised a French budget by mid-February, which is quite ambitious because it's in just 1 month from now. What we've seen with François Bayrou is a change in method. Over the past week, the new finance minister, Éric Lombard, along with the budget minister, have met with all the parties trying to negotiate a new kind of approach with this budget. And the head of the Socialist Party, Olivier Faure, actually said last week there was some progress and he was perhaps open to compromise. The question is, what kind of compromise? The socialists are talking about a suspension of the pension reform. Remember this very controversial that passed after months of protests in 2023. This is something, of course, that would mean François Bayrou could also lose the support of the center-right Republicans, which is something he cannot afford to do. So today, François Bayrou is expected to remain very vague on the budget, very vague on this question on the pension reform. Apparently, he doesn't like the word suspension. He is looking for another word. Clearly, he has no interest in making big announcements because the highest risk of a vote of no confidence is not this week, but next month with the budget.
So a tricky needle to thread, Caroline, but how different actually is the Bayrou government? What are the chances it's going to survive? What kind of budget are we looking at here?
His chances of survival are not that much higher than his predecessor, Michel Barnier, given the parliament is still fragmented in 3 blocks. Marine Le Pen, the leader of the National Rally, still has the upper hand, unless, of course, François Bayrou manages to secure some kind of pact of non-aggression with the socialists, which is what he is trying to do. In terms of what's going to go in this budget, we don't have too much details quite yet. The new finance minister, Éric Lombard, said he saw a spirit of responsibility last week during the discussions with the socialists, but we don't know yet, for example, whether he's going to include some super tax on the profits of the big companies like we saw in the previous government's project. What we know is that he's planning to bring the deficit down from more than 6% last year to between 5 and 5%, 5.5% of GDP this year, which is a target lower than Michel Barnier. And also, he's planning to make about 50 billion euros in savings, when the target before was 60 billion euros. So the Bank of France last night warned about the impact of this political uncertainty on the business confidence and warned that we should have a budget really urgently. Otherwise, the sluggish growth that we're expecting over the next couple of quarters will continue.
Caroline Conan in Paris, thank you very much indeed. Setting us up nicely for our next conversation. Famke Krumbmuller, Executive Director of Geostrategic Business Group at EY, joining us now. Famke, good morning. How would you handicap the chances of the Bayrou government surviving beyond a few weeks?
Well, as Caroline just said, it's exactly the same. Beirut and his government are facing the exact same circumstances as the previous government. And the real challenge in France is the composition of the parliament right now, which is split in the middle. It's three big blocks, no majority. And so his government, as much as the previous government and potentially the next government, will face the exact same challenges around inability to forge majorities on especially more contentious issues. That might be the budget, it might be future pension reform and things like that. So I don't think that much has changed, and it's actually quite important to look at more of the structural issues.
So is today just another step along the road towards early elections, certainly early parliamentary elections, and potentially presidential elections?
Well, let's say that in France, the parliament can only be re-elected every 12 months. That means next time that this will be possible is this summer. I think it is a possibility that we get once more early legislative elections. Whether we do get early presidential elections, that is very difficult to predict. Currently, Macron has ruled out that he will resign, even though polls now show that a majority of the French electorate does want him to resign. Whenever this exactly might happen, and whenever we get new elections in France, including presidential elections, until then, I believe that we will be faced with the current situation, which is really instability, unpredictability, inability to actually really pass significant reforms in France.
So what does that then do to things like borrowing costs? For example, we had Fabrice Lessachet, the VP of MEDEF, of course, representing some of the largest businesses in France, talking about $70 billion that are just then allocated towards things like refinancing, $70 billion that could be allocated elsewhere. How much pain is this for French business at a time when maybe they're already preparing for it? How are you thinking about that?
Well, definitely French business and in general international investors into France are concerned about the current situation because, as always, for business, one of the biggest challenges is uncertainty. And we have very high levels of uncertainty in France since last summer at the very least. And as I just explained, it's expected to continue for some time. We have done surveys at EY at the end of last year. So this is data from October of last year, where we asked international investors about how they think about the current situation in France. And so this was done before the last government fell. And already at that time, 50% said that they think France's attractiveness has reduced since since the early election last summer. So clearly having impact on business confidence.
There's a narrative as well that and France was very vocal about this under the Biden administration, that the only way for European business to compete and for France to compete is to subsidize and to invest in industry. Is there money, or is there even the thought of money down the line that subsidization might be a strategy used by the French?
Well, that is exactly one of the big challenges, and to be honest, not only France faces it right now, is the fact that in general we're seeing much more industrial policy, we're seeing much more subsidies, incentives to try and have companies produce in certain geographies, and a lot of countries, including France even more, at the same time face the challenge of limited fiscal space to actually do so. And as we all know, one of France's main priorities right now is not just to get a budget, but to actually reduce its deficit.
So Beirut's speech today, you present as noise, Famke, Lizzy here in London. I wonder about the long term in politics. If we think about the far right, how powerful are they? What are the chances, in your view, of a Le Pen presidency?
Yes, and I think this is one of the underlying issues here as well, which is the fact that the current situation does not at all resolve, let's say, the challenge around a very strong national rally, so far-right party in France. Even though there was relief last summer that they did not get a majority to have the next government, I believe that this is the main party actually benefiting from the current deadlock, because the French electorate increasingly will seek what they will perceive to be real change, and the wish to try something entirely new. So I think the risk of both an even higher far-right representation after next parliamentary election, as well as potentially a Marine Le Pen presidency, is high, bearing, of course, a court decision at the end of March around whether she's actually eligible again. So more uncertainty on that front as well.
OK, really interesting that you see that as underpriced. But just coming back to where Guy started, Famke, whether Bayrou is really headed for the same fate as Michel Barnier, can he fracture the left, or is that what's going to bring him down?
To be honest, I find it incredibly difficult to predict right now who exactly will collaborate with whom in this under these circumstances. And for me, this points to the broader challenge again about unpredictability in France right now. There is no political culture of compromise, or at least it's a very difficult culture. And so this is something that will need to be forged over the next couple of months if we want to see real change. And so far, it's proven difficult.
Famke, can I just widen the lens just for a moment? Does Europe have a leader that has the backing of the population, the backing of business, the backing of the country to push back against Trump? Is there a leader that stands out to you in Europe at the moment that has that capability?
Well, again, you point to the exact right challenge that I think Europe is facing right now, which is the fact that the two biggest countries, both from an economic but also from a political weight perspective, namely Germany and France, are completely concentrated on their national domestic struggles around no functioning government. Really, Germany faces early elections at the end of February. France, we just talked about, and being so nationally focused, of course, leaves, let's say, empty chairs at the European level to really forcefully respond to international challenges, and that is not just Trump.
Really interesting. Famke Krumbmuller, Executive Director of the Geostrategic Business Group at EY. Lovely to have you with us on the programme as we look ahead to that speech from Prime Minister Bayrou over in France. A tricky needle to thread, as I say. But coming up on the programme, higher cocoa prices help Lindt beat their sales estimates. We're going to take a look at that and your other stocks to watch next. This is Bloomberg.
So I think normally we think of tariffs as a one-off price level shift, and then it goes away a year later. And then provided it's not big enough, you don't have spillover effects. So you don't get second round effects that sort of are inflationary. But if you do rolling tariffs, it's a little bit like the repeat of the pandemic and the Ukraine shock that we had. You have one supply shock after the other, and you start to create sort of a much higher peak in inflation. So I think it'd be much more difficult to sort of know what to do with that as a central bank.
Yeah, economists certainly struggling with that one. The market's certainly struggling with it as well. That was UBS's chief economist, Aaron Captain, speaking to Bloomberg at the UBS Greater China Conference in Shanghai. So the story overnight has been the possibility that maybe the Trump team is looking at the idea of imposing rolling tariffs, i.e. you put them on incrementally as a tool for bargaining with China, Europe, etc., etc. The effects of that could be difficult to determine, according to Aaron Captain. The markets are struggling to figure out exactly how to price this in, but we are getting a big market reaction to what appears at this point to be an early idea coming out of the incoming White House team. The focus, therefore, maybe is in the market reaction, not the actual idea. Mark Cudmore joins us now. He is the Markets Live executive editor here at Bloomberg. Mark, whether or not this policy comes to fruition, I don't know. What I do know is that the market clearly is a coiled spring to react to anything like this. What do you make of the market reaction to the news that this may be more incremental rather than coming in one big hit when it comes to the tariffs?
Good morning, Guy. I think you're absolutely right there in how you phrased it. This just shows the jitteriness of this market. There's been an outsized reaction to a story that really shouldn't be given much credibility in a normal world, but we're not in a normal world. We're in a world which is entirely down to the whim of an incoming president who has promised many different things at various points, and we really have maximum uncertainty about what we deliver. The overnight story, it's important to emphasize that it's a report of one idea being discussed, and as you emphasized there, Guy, this is just the early stages, not even ready to be presented to Trump. The second thing is, this is a completely stupid policy. One of the things about tariffs, apart from the cost, is that the lack of certainty for businesses and the lack of ability to have confidence in their supply chain and to plan ahead. To have this thing where costs are going to continuously be changing, they have to change their prices, they might have to adapt further in the future, depending how far the escalation goes, would be a crazy strategy. So I'd be surprised if it go ahead. And in line with the trend we've seen so far, given that it has not been presented to Trump yet, I would assume that just the normal pattern of these affairs the last few weeks is that we hear a story and then we hear a knockback the other way. That is not with any inside knowledge of what Trump thinks, obviously, or what the administration thinks. But that's just the normal presentation of these themes at the moment under the incoming Trump administration. An idea is floated, then it is pushed back. An idea is floated, then it's pushed back. These are markets that are jittery, and I think it's worrying how far we've gone here. I'm not sure it sustains.
Well, Mark, let's say this idea does come to fruition. Explore the hypothetical with me, if you can, for just a moment. Is it viewed as a dovish take that this is a gradual move and therefore not a shock to the system, the way that a 20% increase all at once may be? Or do you view it as a hawkish take, given that a 20% increase, hypothetically, that he's put forward on Fox News, for example, is still less than a 2% increase every month times 12 months, which is 24%. How are you thinking about this? Is this a dovish take or a hawkish idea?
I think it's a dovish take for the dollar. So first of all, I think the dollar was getting a lot of its strength on a variety of reasons around tariffs. And I think some of the analysis there is a little bit flawed. But most importantly, the shock impact would be positive for the dollar. So I think the softer approach would be negative for the dollar and be positive for the rest of the world. I think the cost for businesses is worse for U.S. companies in this maximum uncertainty situation rather than the price shock relative to other businesses. So I think it's worse for U.S. companies relative to other companies, which is why I'd be very surprised if it proceeds. In terms of the impact on yields, ironically, which is I think what you're most focused on, I actually think it's more of an inflationary impact because you just got ongoing increases rather than one adjustment, one shift in approach. So hawkish for yields, dovish for dollar. I know that sounds confusing, but bad for U.S. companies relative to the rest of the world, and that's why I think it's ultimately unlikely.
All right, Mark Krumbmuller, Bloomberg Markets Live Executive Editor, with your take on our scoop this morning on Trump tariffs. Remember, you can get all the up-to-date analysis and insight from Mark and his team that you need by going to MLIV Go on your terminal. But let's get to the stocks to watch now with Joe Easton from our equities team.
Morning, Lizzy. So BP has reported a bit of a slowdown in some of its production numbers this morning and also delayed a key strategy update by a couple of weeks. That will now take place towards the end of February, according to a statement from the company. Now, we can see BP stock has been a bit of an underperformer recently, given concern around some declining buybacks for the firm. And we have actually started to see a few analyst sell ratings coming onto the stock, 3 on there now, and a lot of analysts sitting on the sidelines. But this does look like a negative read for the London company today. Then over in the chocolate space, we got numbers from Lindt. After a big Christmas period, they're saying they've seen a jump in their retail sales, but the problem with this stock is the rise in cocoa prices over the past year or so has really weighed on their cost outlook and pressured those shares. So this potentially going to be a bit of a relief for the company listed over in Switzerland this morning. Then back here in London, we've got a share sale for British American Tobacco. It's about £1 billion worth of stock by one of the biggest shareholders, around 2% of the market cap. It's priced at around £28 a share. We can see it trading at around 30 at the moment after a decent rally. So potentially a good time to be selling down that and booking a bit of profit on the stock. Now, in terms of the analyst ratings on this one, 10 buys. Analysts this morning writing they don't expect this to affect the company's buyback outlook if they do actually buy some of this stock themselves. Then in terms of analyst ratings, another big morning, a couple that caught my eye over in aerospace. Safran gets a buy over at Jefferies this morning. Goldman has a big note out on the auto space. They like Pirelli in that market. And then over in payment processing, Nexi set to decline today after Morgan Stanley cuts the stock to underweight. That one could be weaker in Italy this morning.
Joe Easton, our equities reporter, we thank you so much. Of course, as Joe was covering some of the stocks to watch, we are getting headlines coming out of France here. The French socialist chief says they may be near an agreement with the government. He is speaking, of course, in an interview with BFM TV. At the same time, the market reaction is interesting. Slight narrowing of the spread between Oates and Boons, and the CAC 40 flying higher by 1.2%.
The implication would be that there is a deal being done on pensions here.
Yeah.
The implication would be that Beirut is going to roll back the Macron 2023 pension reform, which pushed the age higher, because that was the clear red line for the socialists.
Yeah.
That would be a big moment and a big blow to the Macron administration.
It'd be a big blow to the Macron administration. And then for the market reaction, I'm kind of confused by this market reaction, because then it still implies that you are looking at a wider deficit than even Michel Barnier or his predecessors were shooting for. So technically, from a bond market perspective, this still isn't a positive deal necessarily.
No. In fact, from the bond market perspective, you could argue it's a negative deal.
Yeah.
This is a crisis delayed, i.e. there's going to be a bigger problem further down the road. Look at what is happening here in the UK right now.
Yeah, but you're going to have to look at the polls if you want to understand Beirut's thinking and just how low his approval rating is.
Macron's as well.
Yeah, and social security top of the list when you look at what people are concerned about above inflation, after inflation, but ahead of immigration and the deficit. And so social security, pension reform, you really have to factor into the thinking.
Reeves is going to be on her feet a little bit later on. Just to compare, it's interesting, the comparison between the two countries at the moment I think is fascinating in terms of what is going on and the various sort of political permutations that we're watching. Rachel Reeves, the Chancellor, is going to be on her feet a little bit later on. Gilts are about to open in 5 minutes' time. We've got inflation data coming up.
Yeah.
The next kind of 24, 48 hours, I think, are going to be fascinating for the gilts market.
Well, I mentioned that the CAC 40 is flying. Well, the FTSE 100 is literally flat when every other index is higher by 9/10 to 1%.
But do you factor in the pound story off the back of the dollar story, off the back of the Trump story into that in the FTSE?
The ripple effect.
There's a lot to put into the market this morning. Anyway, the markets are about to open. This is what futures look like at the moment, as we highlight. A bit of a difference when it sort of comes through with what is happening with the FTSE 100. European equities, though, picking up on a bounce late in the day yesterday in the States as well. The markets are about to open. This is Bloomberg. Tuesday, the 14th of January, a couple of minutes to go until we start trading here in Europe. Gilts are about to open as well. We're going to watch that very carefully. But let's talk about yesterday's session in the United States. Dip buyers came back a little bit towards the back end of the session. We also had this tariff story beginning to filter into the market consciousness and therefore being priced in to US markets. You can see that jump towards the back end of the session. The blue line there being the US markets, white line European markets. So we've got a little bit to price in on the upside when it comes to the futures, Lizzy.
Indeed, we have, Guy. Look at Eurostoxx 50 futures, higher 0.8%. As you say, factoring in this optimism that Trump's tariffs will be implemented gradually. But the CAC 40 futures absolutely flying this morning above the rest of Europe. And this perhaps because of the political optimism that Beirut can reach a deal. The French socialist chief saying that they may be near agreement with the government. But a little more negativity over in the UK, Kriti. What's in the stocks to watch?
Yeah, perhaps seeing a little bit of the move when you look at some of the individual kind of commodity names. Maybe that's what's weighing on the futures picture, in addition to the geopolitical uncertainty you highlighted in France, certainly spilling over in the UK as well. BP, of course, is top of mind. They're flagging weaker earnings. They're delaying their February strategy update. That could be a major weight in just a few minutes on the opening trade. Lindt is another one. I am a chocolate fan myself, but they are struggling in terms of digesting some of those price hikes, especially when it comes in the face of cocoa prices. Looks like for now it's going to work. That strategy update is something we're going to be keeping an eye on. And then, of course, miners is a big one. We've been talking about dollar weakness pretty consistently. That is showing up in a little bit of a boost for the commodity names outside of oil. That might show up in the stock move as well, Guy.
Kriti, can I just fold something else in as well? If tariffs are incremental, does that favour the luxury sector, which has been hit by that story, that tariff story, over the last few weeks? We'll see how that's priced into the CAC 40 this morning. Is it domestic politics or is it the Trump trade that is going to impact that market? The FTSE 100 is a little light at the get-go. Here we go. We're down by 0.2%, but the IBEX is, as most of Europe is expected to be this morning, up quite nicely. We're up by around 0.6%. The 600's up by around 0.3%. FTSE 100 not going anywhere in a hurry. I'm fascinated to see how the CAC 40 opens this morning. We are watching the politics. We're watching the trade story coming out surrounding this Trump narrative. And as you can see, as we've been highlighting, as Kriti and Lizzy have both been flagging, the CAC 40 is up and outperforming this morning by some considerable margin. Why remains the open question. Let's dig into the details and see what is happening there. Kriti, what do you got?
Yeah, well, your gut instinct was right because your biggest index contributor to the upside is LVMH, followed by Schneider Electric. So maybe there is that story that you were talking about. It is absolutely the French stocks in the lead, and it's a pretty broad rally across the stock 600. You are seeing it everywhere except for the healthcare sector, and that's a place that I thought was quite interesting because some of your underperformers and index weights, I should say, are the likes of GSK and other healthcare names. Well, Novo Nordisk, of course, a big part of that. But you look at the commodity space, outside of BP and Shell, so your oil and natural gas names, the rest are flying and really rallying, and that's really kind of magnifying the move you've seen in the commodity picture as well.
So you've got the JPMorgan conference, just going back to that issue, JPMorgan healthcare conference taking place in San Francisco. Just be aware of that. We'll talk about that in a few minutes' time. Sorry, Lizzy.
No, I was going to say healthcare also near the bottom of the basket, to your point, down nearly 0.1% there, along with energy, as you say. But the rest of the basket in the green, basic resources at the top, higher, nearly a full percent, autos and parts as well. A really positive day here for European equities, but LVMH up 1.6% this morning, so that positivity in France really feeding through there.
Is it positivity in France? Is it this feels like a terror story to me. Has it got anything to do with French politics, or is this to do with the fact that you get incremental tariffs being put on?
Yeah.
French luxury, booze, call it what you will, has been hit hard by that in the past, certainly under the last Trump administration. If it's only coming in incrementally, that would favour names like LVMH.
It is, and it's also but just a broad sentiment story. Every single regional index across Europe is higher except for the FTSE 100, and not by a small margin, anywhere from 0.7% to 1%. Of course, to your point, the France is the outperformer, but again, relative to the likes of Italy, of Spain, etc., not by that much of a margin. We are still waiting for the DAX to open, so we'll see which side of the coin they favour.
BP and Shell are both down pretty hard this morning.
Yeah, pretty aggressively.
BP's down by 3%, Shell's down, which has a higher weighting, down by 1.2%.
So the BP story is a delay in their marketing, right? It's a delay, or sorry, in their capital markets day and their revenue weakness. So that was kind of expected, as Joe had highlighted earlier. Shell is the interesting one because Shell has been rallying quite a bit in line with the natural gas story. So I'm curious if that is perhaps a retracement of some of the giant moves we've seen so far.
Absolutely, but that appears to be why London is underperforming today.
Yeah, absolutely.
It appears to be the energy sector rather than anything, again, related back. There seems to be sort of two broad themes happening in the market. There are kind of, well, three maybe, idiosyncratic kind of company stories. You've got the tariff story, which is being folded in as well, plus the domestic politics stories in the UK and in France as well. I just feel like I should just check in and see how gilts have opened as well.
You definitely
just to see what's happened there. Broadly in line, but actually down more. So gilt yields are down by 4.7 basis points this morning, but all of Europe is lower. So the entire complex in Europe is shifting lower in terms of the yields that we're seeing. The US is down by 3.1%, but there's the gilt trade that we're watching so carefully and will continue to do so as we watch Reeves today and inflation tomorrow.
A lot going on. We should mention that the DAX opened up pretty significantly higher, as well, higher by 0.7%. Basically, what you need to know is we've got a rally on our hands in the stock market and the bond market. So what do? We bring on an Uber bear. Sebastian Raedler joins the program, head of European equity strategy over at Bank of America Global Research, joining the program. All right, so I knew you were coming on the show, so I've prepared for this. I've prepared for the bearishness, for the doom and gloom. But let's kick it off with the news of the day, this tariff story. We've had this discussion all morning of is the idea, it's still an idea, of a gradual tariff increase of 2 to 5% per month, hypothetically. Is that a dovish move for markets, or is that a positive move for markets in that, or a hawkish move for markets in that it, on the one hand, avoids a shock to the system, or on the other hand, could end in 12 months' time with higher tariffs than expected? How are you thinking?
Well, the first thing I would say is the range of outcomes is very wide. We're dealing with an administration that's very unorthodox, that is better prepared than they were last time. And the market is basically knowing, on the one hand, growth momentum is very strong, that has kept risk premium extremely tight. And that's something to be very aware of. We've got risk premium in financial markets. They're at the lowest level in 20 years. So not much is priced in. But the market doesn't know now how much of a hit is going to come. It finds it very hard to quantify. And so therefore, the first thing it does, it just shoots from the hip. If there's something that sounds less aggressive than what you've heard before, that is a positive before you see any disconfirmatory evidence.
You, though, are bearish on Europe in absolute terms, but bullish in relative terms.
That sounds complicated.
In the United States. I don't think it's that complicated at all. The relative trade is you're actually fairly positive on Europe.
Yeah.
In absolute terms, you're fairly negative on Europe because you think broadly the market is going to go lower. But aren't we getting to the point where, even in absolute terms, you've got a super cheap euro, potentially going even lower. You've got European stocks on a kind of historic low valuations. What is the impetus that gets European stocks lower from here?
So I think and I think you're entirely right. It's very important to distinguish between the absolute and the relative story, and they're really worlds apart. In absolute terms, European multiples are roughly in line with the long-run average. The index, the earnings side, an all-time high, margin side, an all-time high. Yep. And you've got basically risk premium that are at the lowest level in 20 years, even in Europe. On relative terms, your relative risk premium at a 20-year high, your price relative is at an all-time low, and you've just underperformed by 15%. So what I'm saying is two things. A, we have to see where the good news is priced in and where it's not priced in. And it's this ironic situation where in absolute terms, a lot of good news is priced in because everything is rich across the board, but in relative terms, you've been a tremendous laggard. And the second point is, why are you here in absolute terms? You're here because global growth momentum has been very strong over the last 2 years. We've been surprised quarter after quarter to the upside. And what we're saying is, global growth is likely going to slow, and we can discuss why, and there are a number of catalysts, and it's something we haven't seen in 2 years. If global growth slows, risk premium will go wider, assets will go lower. But if you've been the laggard, you can outperform because you've already priced more bad news than the rest.
OK, so this is the question I keep asking everybody. If the S&P fell by 10%, would Europe fall by 5% or 15%? Your view is that it's more 5%.
That is correct. And it depends, of course, what else happens. There are two conditions under which Europe outperforms. Either a sharp spike in bond yields. Think about 2022, where Europe was an outperformer despite the war starting in Ukraine and despite the energy crisis, which was really flabbergasting at the time. Europe was outperforming by 10% because it's a value trade benefiting from higher bond yields. The second condition is if your relative growth momentum improves. And we see European growth momentum is very weak at the moment. That has scope to rebound, and we can discuss why, even if global growth starts slowing.
Well, what about the particular UK story? Because you've shifted it to market weight despite all of what's gone on in the past week. Do you still stick by that?
Yeah, that's fine, because we need to remember UK is very interesting domestically at the moment with the bond market, but the FTSE 100 is not a trade on the domestic economy. It's effectively a trade on energy. Energy has been underperforming for 2 years. The UK has underperformed in line. It's very cheap now. So unless you've got a strong view on energy or on pound sterling, the UK FTSE 100 trade is not so interesting.
Yeah, so that's the 100, but domestically in the UK, okay.
Exactly. That is the interesting story. There you've seen tremendous underperformance, 12% over the last couple of months as the sentiment has swung. Your price relative to the market is at a 10-year low. And what I'm saying is I'm bearish, but whenever something is cyclical and very cheap and has sold off, I get interested as a contrarian. So we've just shifted domestic UK to an overweight because we're saying you get fiscal stimulus even if it has to be pared down. So likely we'll see an acceleration in growth, but this is now priced for a sharp slowdown. This is one cyclical trade that seems too bearishly priced at the moment. Domestic UK versus the exporters.
I love that you're a contrarian. This is going to be great. So I found a chart from Torsten Slok over at Apollo, and he did a little bit of number crunching and said that the S&P 500 gets 41% of their revenue from Europe and China. So if you are bearish on the European economy and the China economy, basically everything ex-US, there is some sort of kind of reckoning coming for the S&P 500. If you do the same math for the FTSE 100 or the Stock 600, the majority, a bigger majority of that revenue comes from abroad. You just made that point with the FTSE 100. So if you're bullish on the US and you're bullish on the economic resilience, shouldn't just by design of the index, you be bullish on European equities and underweight the S&P 500?
Absolutely. If you're bullish on US growth, which has been driving global growth, then this will continue to compress risk premium and it will basically limit the downside. What we are saying is that, and I should highlight, our US economists expect growth to flatline in the US at current levels, slightly above trend. But we're just saying there's scope for global growth to slow, and partly, and I was just discussing with Guy, partly because we've seen a tremendous amount of dollar strength. And I've sent a chart to your team, not sure whether they've been able to replicate it. Map the dollar strength relative to global macro surprises. It's a very important trading tool. The dollar leads global macro surprises by around 2 months. There is a price to be paid for the dollar strength that we've seen. There's a very high likelihood that global growth will surprise to the downside over the coming months. If that is the case, typically risk premium go wider, asset prices go lower.
Price to be paid by who?
By the markets.
Right.
So
which markets?
Broad risk asset markets globally that have benefited from the fact that for the last 2 years, global macro data has consistently surprised to the upside. If you now get surprises to the downside, as typically happens after bouts of dollar strength, then that is negative for all asset prices.
Does that outweigh euro parity as an option, as a benefit translated earnings for European equities?
The most important driver of asset prices is global growth momentum, but if you have a cheap currency, you can outperform, hence our call for Europe to...
There's your chart, by the way.
Yes, we did bring it up, and we've got
what
it
an amazing
to show up, to support what you were kind of saying.
Maybe explaining it to the
Go
audience.
for it.
Why is the dollar? It's inverted on the left-hand side. We've seen the strongest bout of dollar strength in 4 years. There's a 2-month lead in there, which I'm not sure is visible on the chart. Macro surprises are very likely going to be more negative than we've seen over recent months because there's a price to be paid if you strengthen the dollar a lot.
But the argument that you're making here is basically that it's, and tell me if I'm watering this down too much, that it's basically too cheap not to own, right? Like, that's the argument you're making. At some point we'll get there, that there will be a point, in a line in the sand where things are too cheap not to own, and we're not there yet.
Exactly. But what I'm saying is, you have to distinguish, and Guy made the point at the beginning, between the absolute cost. Europe is very expensive. The risk premium that you have, the valuations relative to rates, is the most expensive in 20 years. Very hard for me to say, I want to be overweight equities relative to rates. On a relative basis, Europe versus the rest of the world, you're the cheapest you've been in 20 years. Yeah. When it's cheap, I'm interested. When it's expensive, I'm not. And I think that's really what it...
But you're basing that more on the rates picture than the rest of the world picture. So if you're an equity allocator, you're basically looking at it from a macro allocation standpoint. But if you're a sole equity allocator, you do want to be bullish on Europe.
I want to be bullish on Europe relative, and I like how you're trying to
I'm going to get you one day.
A little bit of bullish. You will. What I'm saying is, if global growth slows, if macro data surprises to the downside, it's negative for risk asset prices, especially if no risk is priced. Risk premium at a 20-year low. A little bit goes wrong on the macro front, you have to price a higher risk premium. That's not good news for asset prices.
Sebastian, always a pleasure.
Thank you.
Thank you very much indeed. Very well prepared. Everybody's very well prepared. Sebastian Raedler, Head of European Equity Strategy, Bank of America Global Research. Core 6 looks like this morning. LVMH is having a good day. The luxury sector certainly is positive, as is everything else, as you can see. Green across the board. What else you got, Joe? Let's find out what's going on with the wider markets.
So we have got some big moves in UK retail today. Guy, JD Sports absolutely slammed at the moment, down another 11%. This stock trading at the lowest level since 2020 now. The company warning of a decline in sales across November and December, not just in the UK, but also in the US as well, where they've done a lot of M&A trying to expand into that market. So as I say, that stock now at a 4-year low, yet another profit warning from JD Sports today. Then going the other way, we've got Ocado, the best performer in Europe today. Now, this is all driven by their retail business, their joint venture with Marks & Spencer's, which they say had their best ever Christmas, and that is countering a big slowdown in some of their robotic warehouse sales, according to the statement today. That stock rallying 12% in the retail space, as I say, best performer in Europe today. Then, in terms of your oil majors, we have that update from BP warning of a slowdown in quarterly production. Now, that was partly expected by the market, but we are seeing a little bit of a feed through into some of the other stocks there. Shell, Total Energies, all declining. Bear in mind, those shares did rise yesterday as we saw a 2-day jump in the oil price, but that having an impact on the oil majors in the European market. BP delaying a strategy update as well. Then in terms of chocolate, we've got Lindt. Now, this is all about margins, according to analysts today. They were expecting a bit of a slowdown in the margin growth, given that massive jump that we've seen in cocoa prices over the past year. But that has not come to fruition, and Lindt actually beating forecasts on both earnings and margins. In your ratings, from chocolate to booze, a couple of our favourite subjects, we have got Remy downgraded to underperformer over at Bank of America. A little bit of a decline on that one. And Nexi got a downgrade, and that was one of the worst performers in the payment processing space. That one was slipping after Morgan Stanley goes underweight, down 2.8% in Italy this morning.
All right, Joe Easton from our equities team, we thank you. With our stocks moving at the open. Coming up on the programme, we're going to switch focus to healthcare. M&A very much in the spotlight as leaders meet at the JPMorgan conference over in San Francisco. We'll bring you all the highlights next. This is Bloomberg.
Obviously, there's a lot of commentary on what the new administration's approach to vaccination will be. I think we should wait and see what the facts are when they come through. But any conversation about the efficacy of vaccines, the quality of vaccines, these are things my company is deeply committed to and we want to engage on with transparency.
Very animated GSK CEO Elle Walmsley speaking to Bloomberg from the JPMorgan Healthcare Conference, which is currently taking place in San Francisco. Started yesterday, keeps going for the next few days. Sam Fazeli, senior pharmaceutical analyst at Bloomberg Intelligence, still here in London, enjoying the weather here, not there. Let's talk about GSK first of all. She's quite animated, but that doesn't feel like it's being reflected in the share price right now. What is it? Is GSK emblematic of the wider healthcare sector at the moment? Is it idiosyncratic in terms of the problems it faces or the opportunities that it's potentially got on the horizon? What would you say about the potential for Emma Walmsley to outperform here?
Well, she certainly has the energy, Guy. I mean, yes. That's really nice and it's kind of infectious. And you've had her on the scene here, right?
Yeah.
So, look, the thing is that you have to take CEOs, of course. She's not going to sit there and say, oh, God, things are terrible.
No.
You know, at the end of the day, they still have a business to drive and a growth to deliver. And one of the issues that they've faced is that they had a product, the RSV vaccine for respiratory syncytial virus. Maybe that's what I had, right? It got off to an amazingly strong start, and then it started petering out when the reality became an issue, just like the COVID vaccines, just like many of these situations where you rely on people's actions to go and take a shot and government regulations to set it up. It's not like cancer where you got cancer, you get treated if you have access. So that's what happened to that vaccine. The forecast for that vaccine consensus has fallen. Is it a 2-year shot? Is it a 3-year shot? Which group of people should take it? And there's been a lot of pressure on that. That's why the stock has really taken a hammering in the past 6 to 9 months.
What else is on the agenda for this conference? And I say this in the context of a regulatory environment that's about to get a lot easier for M&A and for acquisitions. We know the biotech companies love to do that. How much appetite is there right now in the sector for that?
Oh, there's massive appetite. I mean, there's $200 to $300 billion worth of drug sales, depending on how you measure it, how far you go out, that are going to come off patent. Yeah. So we have a situation again where pharma companies need access to assets. And we've had 3 deals announced yesterday. Unfortunately, it doesn't help the biotech sector because 2 of them were from private companies. What really drives the biotech sector is if the $3, $4, $5 billion companies get taken out. The public deal we had was Johnson and Johnson, which we believe was an excellent match for what they're doing, and perhaps some questions about competition coming up, as to your point, with regards to they have some assets, they acquired a similar asset, what's going to happen? And that was a product in market. So there seems to be a bit of a disconnect where biotech investors are invested, the pharma companies aren't coming yet.
So that's deal making. Of course, the Biden administration kind of anti-deal making there. But broadly, what's been the mood music on the incoming Trump administration at the conference in San Francisco? You know, Robert F. Kennedy, famously accusing the drug companies of corruption, talk about mass poisoning, critical of vaccines. Are they still managing to be optimistic over in San Francisco?
They are. If you listen to various people, and pretty much every single individual CEO presenting was asked this question. In soft ways, in hard ways, or RFK Jr., is it bad for the sector? The reality is that they all have to work with this administration. And if he's confirmed, they have to work with him, right? So they can't really take a tough stance here. The reality is some of the things that RFK Jr. has said make sense. Many of the things he has said, you really make no sense at all. Take vaccines. Vaccines are one of the best things that humanity ever invented for itself in terms of healthcare and protection, right? So that's where I think a lot of these folks are trying to get grips with the reality that they've got and manage it.
Everything seems to be an AI trade these days. Is that also the conversation in San Francisco? How much AI is involved in this process now? Which science should we most be excited about? We've also got computing power coming up really rapidly. The ability to understand what is happening at an atomic level is increasing dramatically. How quickly will that impact? Are we getting a flavour from that in San Francisco?
Yes. So both NVIDIA and Dassault Systèmes presented yesterday. And NVIDIA, of course, did its usual thing, saying we have a solution for everything.
Yep.
Right? And they probably do. I mean, I don't cover NVIDIA. One of my colleagues does. And we know where the share market cap is. So that's reflected there. They have a product, a technology, the systems that allow you to do AI. And it's rapidly evolving. Digital twins, robotics, the physical AI, if you want to call it that, agentic AI, all of that's happening. And it's getting deployed in pharma. It's just that pharma companies are, in my view, a little bit like oil tankers. It does take a while to shift it, right? The easy applications are happening now. You know, I'm looking forward to having a podcast with our head of R&D at GSK next week, where we will talk about this. I think they're highly focused on the application of AI and the machine learning to data management for a start, right? These companies are generating data at the speed of light, right? That needs to be managed and understood. There's no question. It's just the timing of how deep it will go will depend on how fast the companies can move.
Sam Fazeli, senior pharmaceutical analyst over at Bloomberg Intelligence, walking us through, of course, the key points and conversations happening in San Francisco around the JPMorgan Healthcare Conference there. I want to talk to another top story happening in California, 6 hours south of San Francisco in L.A. Southern California broadly facing another round of dangerous fire weather as crews struggle to contain wind-driven blazes that have paralyzed Los Angeles for nearly a week and killed at least 24 people. Now, the disaster is expected to be among the costliest in U.S. history, with estimated damages and losses between, get this, $250 to $275 billion. Insurance industry losses alone now estimated at $30 billion. Joining us for more is Bloomberg Intelligence European insurance analyst Charles Graham. Charles, these numbers just keep getting higher and higher. How dangerous is this for the people and for the insurance companies that have pulled out on covering this area?
Well, I think the first thing to say is obviously this is still an ongoing disaster. We have a red warning in place from the Weather Service, the threat of an increase in high winds, and the risk is that more areas of Los Angeles could yet be under threat. And I'm sure this must be an extremely worrying time for the people of the city. Obviously, as this has developed over the last, only really the last week, I mean, we've seen initial estimates of around $10 billion for the insured loss, then rise to 20. Now we're talking about 30 billion. And I think it also stands out that that's a very small fraction of the total economic loss, because insurance availability was a big issue for this market.
But Charles, this was a known risk, right? Is this a wake-up call, for want of a better phrase, for these communities in vulnerable areas in an era of climate change?
I think it is. These were some of the areas that were most exposed to wildfire risk of anywhere in the United States, because of the combination of population density, property values, and proximity to bush. And as a result of that, a number of major insurance groups within the US decided that these risks just weren't insurable. And it was also an area where it was difficult for those companies to, in some cases, get reinsurance protection. And what we've seen now is that as the losses have climbed, we've gone from a position where the expectation was the loss would be taken primarily by all the domestic insurers, to a position where once we get above sort of 20 billion of loss and heading towards 30, then that begins to go into their reinsurance programs.
OK. Charles Graham of Bloomberg Intelligence, those costs climbing and, sadly, the human toll as well. Plenty more coming up on the programme. This is Bloomberg.
very important, the Chancellor, having set out some fiscal targets, having said that she's going to take the public finances seriously, which is very important, that she doesn't erode that credibility.
The markets are not trusting at the moment the new government's commitment to their own fiscal rules.
A change to the fiscal rules might be one thing that could trigger a Liz Truss episode.
And you could be in this never-ending silly merry-go-round because of a move in global bond yields. You know, more sensibly, there isn't any pressure on her to do anything about the markets or her own rules till at least March, when the OBR will come out with their updated forecasts.
Fundamentally, this is an international problem, partly caused by the Trump administration and uncertainty, and we shouldn't panic.
Should we panic? Is the UK market turmoil a UK story, an international story? It's been a debate among our recent guests on Bloomberg TV and radio, reacting to the storm that's rocked our yields and the pound as well. Rachel Reeves very much in the spotlight, her economic agenda at risk. She's speaking in Parliament later, and we can speak now to a man who advised a previous UK Chancellor in a time of austerity. That seems to be what the market's calling for. Rupert Harrison, former Chief of Staff to UK Conservative Chancellor George Osborne and Chair of the UK's Council of Economic Advisers from 2010 to 2015. Good to have you with us, Rupert. If you were advising Rachel Reeves at this point, I wonder how much further you'd have to see yields rising or the pound falling for you to tell her you need to do a bit more, say a bit more, than that you're wedded to your fiscal rules.
Well, there'll be a bit of a sigh of relief in the Treasury this morning. This is the first, certainly as of this morning, the first down day in gilt yields and the first small uptick back in sterling that we've had for at least a week now. But, of course, they're not out of the danger zone. We've got UK inflation data tomorrow, which I think will be a key driver of gilt yields, and markets very nervously watching particularly the services inflation. I think that Rachel Reeves will, for now, be getting advice from the Treasury that I think don't panic is correct. This is not an immediate market crisis. I think, you know, there are things that could turn it into an immediate market crisis. Any sense that she was getting ready to abandon her fiscal rules and that she wasn't taking any signal from the markets, I think that would be concerning. But what they will be doing is very nervously waiting and watching what happens to gilt yields during February, because that is the period during which the Office for Budget Responsibility will take their average on which they will then base the forecast they're going to publish at the end of March. And from a sort of political point of view, that forecast is the key for Rachel Reeves, because if she is shown in that forecast to be missing her fiscal rules, then she is going to have to come back just 5 months after her budget, and she's going to have to tweak her spending plans, and that's going to be politically extremely embarrassing, and also a very tough sell within the Labour Party.
Yeah, indeed. She's already signalled to us that if the OBR deems her to have run out of headroom, she would pick spending cuts over tax rises. But I wonder, Rupert, if you share some economists' worry that spending cuts, any spending cuts she announces, would lack credibility with markets.
Well, I think that there is a serious risk of that. And I think particularly the most likely option is that she will trim her spending envelope in the last few years of the forecast. And this is something that markets are now very used to UK governments doing. It would be probably outside of the 3-year window of the spending review that she's probably going to set. And therefore, it's just a stroke of a pen. It's just changing some numbers on a page. It's not real action. It's not very credible. It might be enough to get her out of a political fix, but it will leave a lingering sense of, where's the action? Do they have credibility? There are things she could do up front to earn more credibility. She could bring forward some of the welfare reforms and some of the planned savings to, for example, the rising sickness benefits bill, to make savings in years 1 and 2 and demonstrate action. But I think that is going to be both difficult to implement and also politically difficult for her. So, yes, I think the most likely option will be lacking in credibility, but it might be enough to, get her through to the autumn when she can give a more comprehensive budget.
Can she afford to wait until then? Rupert, good morning, it's Guy. There is a worry that if she takes any kind of action, near-term action, that it in some ways would confirm that there is a crisis. How long can she really wait? Can she afford to wait that long?
No, I don't think that is going to feed a sort of spiral of crisis. I think that markets would take some security from signs that she was acting early to get on top of her spending envelope, that she understood the problem. effectively she's got a political problem. There's also an economic problem, which is the government's borrowing is crowding out the private sector. It's pushing up borrowing costs for households, for businesses, because markets are finding the government borrowing so hard to digest. So she's actually in a situation where if she could get control of spending in the short term, that might actually provide a boost to the economy. Now, I think that that's unlikely. I think she probably can wait to the autumn unless we get into a significantly worse market situation. And, the inflation data will be important. Recent global moves have been driven by expectations around the Fed and particularly Trump policy. I think we should also not ignore the actions the Biden administration has taken in terms of clamping down on sanctions on shipping of Russian oil that has pushed up oil prices. And that has also been a driver of these rises in gilt yields. So all of these things could get worse between now and the autumn, or they could improve. And she's going to be very vulnerable to those market moves.
Can and should the Bank of England help at this juncture? The bank is still selling gilts into the markets. Given the fact that some of this crisis appears to be imported from elsewhere, you mentioned what is happening in America, US 10 years heading towards 5%. Should the Bank of England maybe tactically think about ways that it can alleviate the situation?
So I think the Bank of England could and should separate its QT bond selling operations from monetary policy. And I think that that is still the right frame. If they're concerned about the impact on the economy and their ability to hit the inflation target, they can just cut rates. And that would bring down yields right across the curve. I think that they will be very careful not to get involved in the long end of the gilt yield. They will view that, of the gilt curve, they will rightly view that as the government's problem. A bit like we saw during the trust episode, the Bank of England will say, this is your problem, you fix it. We are rightly focused on hitting our inflation target, managing our balance sheet. Those things should not be driven by government fiscal policy. Then you get into fiscal dominance, and that leads to all sorts of pain in terms of rising term premia and is less good for the economy in the long term. So it's very important that the Bank of England is not seen to be riding to the rescue of the government. This is very much something that is squarely on Rachel Reeves's agenda and not on the governor's agenda.
Rupert, it's Kriti in London as well. You keep talking about the weakness that we saw in the markets, of course, concentrated in the last week. But I would argue that we've been sounding the alarm on the UK's finances for at least the last year, if not longer. Is there a line in the sand for sterling or for the gilt market, or even arguably the FTSE 100, if you want to go that far, that really signals or prompts some sort of emergency measures or a more dire, more bigger response from the government, from the Bank of England, or anyone else at play? Is there a line in the sand you're watching?
Well, I think we're some way away from that, but you are absolutely right that this is something at least of the last 2 or 3 years. I mean, in fact, if you look at the long end of the UK curve, really ever since the Trump mini-budget crisis, the UK 30-year yields have been above US 30-year yields, and they have not come back down below. And I think that we have seen a kind of break in demand for long-dated UK government debt. And fundamentally, you've got a defined benefit pension system and an LDI system that is smaller than it used to be. There is not that kind of deep pool of demand for UK government debt that there was a few years ago and that we got used to for several decades. And I think that speaks to the fact that the UK government is just going to have to work harder to demonstrate fiscal responsibility. It's going to have to pay a higher price to get its debt away. And that's just the environment we're living in. In terms of that kind of trigger point you're talking about, I think that is expressed in rates of change rather than levels. So again, if we get into a sort of doom loop spiral where yields are rising idiosyncratically in the UK, that is forcing selling from actors in the market, and that is driving down the currency. The kind of dynamics we've seen in the trust episode, that's the kind of environment where you need emergency action. Now, we're a long way away from that. I'm not saying it can't happen, but that's not the market environment we're in at the moment. At the moment, this is a medium-term signal to the government that the price of this extra borrowing is going to be high, and you need to factor that into your plans.
As you say, though, 7 a.m. tomorrow morning, we get inflation data. The market's going to be watching that very carefully. Rupert, great to catch up. Thank you very much indeed for your time this morning. Rupert Harrison, former chair of the UK's Council of Economic Advisers. We greatly appreciate it. Find out a little bit more about how the UK bond markets could be impacting personal finances. There's a live Q&A on Bloomberg.com that is taking place today at 12 p.m. London time. Bloomberg reporters are going to be breaking down the implications for UK mortgage rates. Take a look at what is happening in swaps at the moment, what's happening in savings, what's happening in the equity market. All of this is going to be covered. Terminal clients and digital subscribers can log on and put questions directly to the team, Kriti.
It's certainly something we're going to be watching very, very closely. In the meantime, let's get to some of our other top stories. Chinese officials are said to be discussing the sale of TikTok's U.S. operations to Elon Musk. We're going to dive into the details next. Stick with us. This is Bloomberg. Welcome back to the opening trade. We're about 44 minutes into today's session. Seeing green on the screen everywhere across Europe except for the FTSE 100. That is the underperformer. We'll see, of course, if that changes as we get maybe a little bit more policy direction throughout the rest of the day. But at the moment, it feels like policy is in the driver's seat for all of Europe, specifically in the European Union, where the top digital official has said that the repeated cutting of undersea cables in the Baltic Sea cannot be fully accidental. Henna Virkkunen says the bloc needs to be ready for a range of hybrid threats. She also told our very own Oliver Crook that the EU is looking forward to working with the new U.S. president. Take a listen.
Of course, the USA is the most important ally for European Union when it comes to security and also for the economical side. So also at the same time, our sovereignty of our member states, of course, has to be respected. But USA is a very important ally for European Union as well for Denmark. So we are very much looking forward to cooperation with the Trump administration.
One of the things that we've seen a lot of over the last few weeks and months has been damage to undersea cables. I'd like to get an update from you on kind of what we actually know about what has occurred. Or can you establish definitively that this has been sabotage? Do you know who is responsible for it? I know this is going to be a focus for you this week at the Baltic Summit.
Yeah, when it comes to these incidents in Baltic Sea, the Finnish authorities, they are currently investigating this, and they have been working very efficiently. But we will gather together with 8 Baltic Sea countries and with NATO and EU on Tuesday on Helsinki to discuss about these topics, that how we can better prevent and detect and also respond to that kind of incidents. And of course, it can't be really by accident if these are happening many times a year, that oil tanker is navigating anchor on the bottom of the sea and digging the critical infrastructure up.
Yeah, and I think that I wonder if what you think about this. I mean, because of the war in the Ukraine, the horrors that we've seen in Ukraine, and also, you know, in the Middle East, I think there's a bit of a distract. We've been a bit desensitized. If this was happening when there wasn't war around, I think Europe would be much more concerned. Do you think we're already basically in Europe in hybrid warfare with Russia?
It's for sure that we have to be prepared for very different kind of things and different hybrid threats. We have seen that nowadays everything can be weaponized, like migrants. We have been seeing weaponization of migration on our external borders. We have been seeing foreign interference to elections and also damages and sabotage of the critical infrastructure. So it's for sure that Europe has to be better prepared also in the future.
Henna Virkkunen, the European Commission Executive Vice President for Tech Sovereignty there, speaking to our very own Oliver Crook. Ollie joins us now. Ollie, she said that last line, that everything can be weaponized, from elections to migrants. What else does she have to say about the defense front?
Yeah, so listen, Kriti, I mean, this is going to be one of the main focuses going into this new commission. You know, these people are going to be around for the next 5 years and sort of appraising kind of the landscape as it stands, what the biggest sort of issues that Europe are facing. That threat of hybrid warfare is certainly going to be very top of the agenda, particularly for her. I mean, the undersea cables is just one side of it. And we were mentioning the Baltic Summit. This is where leaders from the Baltic countries around the sea there are going to be meeting in Helsinki today. You know, Rupert will be there, the head of NATO, but so will Olaf Scholz, to sort of discuss how they can deal with this. How can they deploy more ships to sort of be patrolling what's going on in the Baltic Sea, because these are sort of major infractions that, again, if we were not sort of more sort of inundated with war across the world, would be very, very shocking to Europeans. This had to be a top priority. But it's not just undersea cables. There's also the question of migration. She comes from Finland. Finland is that huge land border with Russia. That border has been closed for over a year because there's been this question of weaponizing migrants and sending them over the border. But then there's also this question, this is not just in the Baltic Sea and the border with Russia. The Germans, for example, have now said that the military is allowed to shoot down drones over German airspace because there's been a lot of strange drone activity around military installations, around industrial complexes. So this is something that they need to pay very sort of close attention to across the board, to say nothing of the sort of defense spend question. We heard from the NATO Secretary General speaking yesterday in Brussels before MEPs, basically saying, if you don't want to spend more on defense, you guys should get your Russian language books ready, because in 5 years this is going to be a major problem for Europe. He says that 2% is just not going to cut it. Remember, Trump has asked for 5% in terms of NATO defense spend. He sees that settling around 4%. And then the question, of course, are always around that, how do you pay for it?
Ollie, fantastic conversation. Really interesting, particularly as well, because Virkkunen's got numerous hats. She's in charge as well of tech sovereignty, democracy in Europe, and sits really at the centre of this X platform investigation and Elon Musk influence in politics. What's she been saying about him as well?
Yeah, so listen, I mean, this is the thing. This is really one of the main things that's under her portfolio, and she is now directing the sort of investigation into the X platform under the Digital Services Act in Europe. This is the regulatory power that they have around these sort of platforms in order to discuss basically, is there undue influence and is there an unfair advantage being given to certain political threads, certain political perspectives on the platform. So that investigation, on the X platform, broadly speaking, has been going on for basically over a year. What she said in this conversation that we had yesterday is that they're actually now looking at expanding that investigation on X in light of the fact that there is this German election coming up in just a few weeks, and of course everything that has been sort of his sort of support for the AfD. But there's also, for example, an investigation going on into TikTok because of its possible influence in what happened on the Romanian election. I think the other thing that is sort of going unsaid right now in Brussels, but I think is going to be a thread throughout this sort of administration, is the degree to which, and we heard Mark Zuckerberg make this reference to this to Joe Rogan over the weekend, talking about basically, he was referring to sort of European fines as tariffs on American tech companies. He was calling on Donald Trump to protect American tech companies from the European Union. To what degree is that going to sort of govern European policy? Will they go out a little bit lighter? Of course, no one who's sort of involved in regulatory circles will openly admit that, but that is certainly in the air here in Brussels.
Ollie, great stuff. Thank you very much indeed. Ollie Crook, after a fantastic conversation surrounding what could come next in terms of defence spending and how Europe figures out its borders. Let's carry on in some ways with a related conversation. Chinese officials are said to be discussing the sale of TikTok's US operations to Elon Musk. The app is said to, we understand, be banned in the United States on Sunday. This, of course, unless it is divested by its Chinese owner, ByteDance. We're watching the legal case proceeding very carefully. Bloomberg tech analyst Tamlin Basin joins us now around the table from Bloomberg Intelligence. This feels very speculative at the moment. Does it make sense that Musk would buy it? Is it logical that this would proceed down that route? What details are there actually about that possibility?
Right, and I think you're right. This does feel very speculative at the moment. And we also have a pretty tight timeline. On January 19th, TikTok is going to be banned pursuant to that legislation that was passed in the U.S. There was the argument on Friday at the Supreme Court. Certainly did not seem to go TikTok's way. So this could be sort of a last-ditch effort to sort of try to buy some more time. And the reason being is that they could potentially get a 90-day extension of that deadline if they can show that there are efforts being made to divest TikTok's U.S. operation. So I think that's the way we look at it right now, that this could possibly be a bid to go down that avenue.
Talk to us a little bit about just the response from ByteDance as well, simply because I think the last time we had you on, there was still a conversation of what American tech companies, not Elon Musk related, may want a piece of this. Amazon, Walmart, Oracle, etc. Does ByteDance have a preference here, or is this just all about cozying up to Donald Trump?
Right, and I think I saw some statements from ByteDance saying that this is not necessarily, they weren't agreeing with the reporting on this. They were pushing back a little bit. But I think for a lot of those companies you mentioned, that there could be serious regulatory concerns over allowing consolidation in social media to that extent. Walmart probably a little bit different, but certainly sort of the Meta, possibly even Amazon. It'd be an interesting question whether sort of Musk, who also owns X, whether his purchase of that would raise the same concern. So it'll be interesting to see if this proceeds, how that might garner attention.
Yeah, so potential other suitors, but if this TikTok ban does go ahead, could be good news for other social platforms.
Well, I think that's an interesting thing. If this does go ahead, it arguably decreases competition in the U.S. on social media. So this is actually an interesting case where potentially keeping it on the market in the U.S. could actually, further competition, at least in the advertising sector in social media.
Is there an issue with Musk buying it just because he's so close to the president? Would there be legal? How would it? Is that an advantage or a disadvantage?
I would probably look at it potentially as an advantage in this stage, only because if there was going to be pushback on it, it would come from the DOJ or potentially the FTC. We've already thought that there's going to be sort of less concerns on some competition in terms of consolidation under the FTC than there was under Biden's administration. Musk being very close to President Trump, President-elect Trump also saying he sort of shifted his stance on TikTok, where in the first term he obviously was one of the leading charge to ban it, and now he said he has a soft spot in his heart. So I think in this instance, Musk being close to the president could be an advantage.
All right.
Okay.
Tamlin Basin of Bloomberg Intelligence walking us through the tech story. This is going to be a fun one. We're going to see him more and more, of course, as we get more information around this. But it really comes down to the same concept. What is Donald Trump shooting for here in this era of deregulation domestically, but protectionism to the rest of the world? Is the approach that Bloomberg reported this morning of gradual tariffs the right one?
Balloons are clearly being floated, and we're trying to get a sense of what is happening within the White House right now. There is clearly a concern about the inflationary impact of tariffs. I think this story demonstrates that. Clearly, within the economic circles within the White House, there is a worry that if you put it all in at once, you are going to end up with an inflationary impact. We've learned, and the last election proved this, the inflationary impact and how that can show up in polling. So there's clearly some fear here. But there's also this instinct that Trump has surrounding tariffs and the impact and the positive impact that they can have. He talked about it when he talked to John Micklethwait, his biggest favourite word. He clearly is on board with the idea that tariffs should be used, and his normal strategy is to go big early.
Yeah.
Not to go incrementally and gradually ratchet things up. The instinct that he has had in the past is going with both feet and then work your way back from there, rather than working your way forward to ultimately end up maybe in the same place. So it's clearly two different strategies that are being represented here.
But this story is a variation on a theme we've already heard. We had that Washington Post report saying that the Trump tariffs would be limited to critical industries.
And look what happened.
Yeah,
he came straight back.
Exactly. So the market reacted, then the moves reversed. Now it's about the pace rather than the targets. The market's reacted. Is it surprising that the market's reacted when it reversed last time?
But you know what's so surprising about this is how much how many people, how many CEOs and big names are hopping on the tariff train. Jamie Dimon, for example, on the Sunday show, talking at CBS, basically saying this actually might be an effective strategy to rebalance. He didn't say it was going to be 100% or he's going to, but it's I think the most pro-tariff comment I think he's made on record. A similar story with some of the tech names as well. Everyone's getting on board with Donald Trump.
Everyone fighting for their invitation to Mar-a-Lago. Zuckerberg and his fact-checking walk back. So
it's interesting that how the landscape is changing as quickly as it is. Are we ultimately heading towards some sort of Plaza 2, Mar-a-Lago kind of agreements that could change the global landscape in a significant way? Besson certainly talks about that. Truss is going to be speaking a little bit later on. We're going to get the first sort of inkling out of the new French government as to what kind of a deal has been done on pensions. It's a really busy day coming up. This time tomorrow as well, we'll have UK inflation data to fold into the narrative as well. It's a busy 24 hours coming up.
I think that was a Freudian slip. You said Truss, but you meant Reeves.
Sorry, Reeves. Did I say Truss?
Well, Reeves, Beirut, a little bit of Trump. We've got plenty to watch as well, plus the Senate confirmation hearings later in the week as well. 102 on Eurodollar, 122 on cable. Some strength in Europe today. Does it last throughout the day, as we, of course, have all of the things we just talked about on the agenda? That does it for the opening trade. The Pulse is up next. This is Bloomberg.